Okay, welcome back everybody. In this lecture we'll be talking about the macroeconomic functions of business. What is some of the drivers of business investment? Of course, business investment referring to the way in which we categorize business spending within the national income accounts, how the rate of interest affects business investment, how expectations affect business investment, and then finally some of the basics of the public regulation of business. So what does that sort of look like? Okay, in the last lecture, of course, on households, we looked at how households had to choose, of course, between receiving income, right, and then they have to choose between spending today versus spending tomorrow. With business, we have a similar consideration. Businesses, of course, have to hire raw materials, they have to hire factors of production, right, and then turn those into business revenues. But of course, they have to hire those factors of production ahead of receiving business revenues. So the question of whether or not to invest is really the key decision for business. Should they take the capital that they have and produce, or direct that capital towards some other type of activity?
Okay, so the economic decision for businesses to invest, of course, is a matter of several factors, right? And here I am standing in front of standing in a redevelopment area of my small town here. Behind me is a recently constructed housing project. And of course, these owners of this project had to decide whether to utilize that financial capital in a way that they built this building. Because of course, they could have taken that same capital and stuck it in asset markets somewhere.
So as I say, businesses hire factors of production, right, and then they convert those factors of production into finished goods and services. So if we recall our circular flow diagram from last time, right, we have that real input of factors of production for which businesses return the nominal income, wages, interest earned, so on and so forth, and of course produce the real thing of finished goods and services and receive back the nominal payment of revenues. So then, of course, businesses making a decision consciously each time to hire factors of production, but of course it's not a given, right? Owners of businesses don't have to do that, right? They don't have to continue hiring factors of production. And indeed, without maybe recognizing it, you're making the same decision. Right? To put some numbers to that idea, if you can, you're thinking, like, going back to the last slide, you're thinking like, oh, well, I'm invested in the stock market because I figure I can earn 5-6% return, and I'm worried if I start a business I'm going to lose money. Well, right. Well, that's the same. That's the same set of information that everybody else has too. If I can earn 10% in the markets, but my business is only likely to turn 5%, then there's just no way, right? It's not that business is not a viable concern. Now, when we think about those two choices, right? So I'm thinking like I own a business, right? I can rehire my factors of production for another period, or I can simply invest in existing assets, right? If we are engaging in new production and hiring factors of production, we're contributing to new economic activity, like the shovel and digger over there, right? New things are being created in the economy, and as such, we're contributing to the real resources and real production. Whereas if we choose to buy up existing assets with that financial capital, like the picture on the right below, where she's buying a car, right? What we're effectively doing is bidding up the price of those assets and not contributing to new production. One is raising the price of existing assets while the other is creating new assets. Okay, and so that's the business decision. How does the rate of interest then impact that decision? Of course, as we saw over the last series of lectures, the rate of interest is the time price of liquidity, so the price of liquidity today in terms of liquidity in the future. Well, it's fairly straightforward to say that the lower the rate of interest, right, effectively the cheaper it is to invest today, both in terms of direct costs, right, both in terms of the price to actually get the capital, but also in terms of the opportunity cost associated with the capital. Okay, if I'm using my own capital and interest rates are very low, then what I could have gotten to let other people use that is very little. If I'm borrowing from others, then it's fairly straightforward. Lower rate of interest, right? Lower cost of business invest, as well as lower return in general on other types of assets, right? So lower interest rates, it effectively becomes easier for businesses to create new production, and lowers the return to them existing in or bidding up the prices of existing assets, all things being equal. I know a lot of you are thinking, well, low interest rates drive up asset prices. Yes, for sure it's true, right? So it's not this simple. This is introductory macroeconomics, and so simple models, right, and basic ideas, right? But in the very most basic sense, lower interest rates means lower costs of investment, and also reduces those returns on other existing assets, like all things being equal. Okay. That said, of course, there are other decisions that go into the or other factors that go into the business decision to invest, right? It's not just the price of financial capital in terms of the rate of interest. I mean, that's not unimportant, but far more important is expected revenues, right? So if businesses can expect to earn more, right, then that. And so we also need to understand that it's not just the rate of interest, but also sort of forecasts about future business performance that are going to affect that decision to invest, right? So the most important thing is that expected future business revenues. So let's take these ideas and try to think about how we might model them, like we've done in previous lectures. So let's say that business investment is a function of, and this is right there, right? Business investment is a function of the rate of interest, lowercase I, but also incomes, y, and particularly expected incomes in the future, right? And so we'll call that idea y subscript t plus 1, as we see in the bottom line down here. Okay. Now you'll notice a few things about this. We've included I0, which is sort of we're acknowledging that there are other exogenous factors that are going to impact our model, right? There are things outside this. There's things besides interest rates and incomes that are going to affect business investment, right? But then also that we expect incomes to have a positive relationship and interest rates to have a negative relationship on business investment. So that's why we have the positive sign in front of 1 and the negative sign in front of I2. Now, just like before with households, the variables I0, I1, and I2 would be behavioral, and they would have to be estimated from the data. You might grab some data and just try to estimate those yourself from the data. All that data is available at the Fred site. So here's our list of variables, as well as an explanation of business investment on the previous slide. Probably should pause this, write those down. Okay, and here's what that says, right? So now we've got a theory of business investment, or a maybe better stated hypothesis of business investment, because we haven't tested it yet. And it says this, right? Businesses sometimes invest for reasons that we don't know. I0, exogenous factors, right? If incomes are greater, businesses will invest more. If interest rates are higher, businesses will invest less, right? That's pretty simple, right? It's not a complicated theory of business investment, but yet, as we'll see, as I think you're starting to get a feel for already, but as we'll see a little further along in the course, it's sufficient to explain a whole lot. Right, it's sufficient to explain a whole lot and really to get a citizen's handle on how the macroeconomy works. Let's take this idea now of business investment and plug it into our idea from before with households, and we get something like this. We get this explanation of the economy here. It's starting to look really scary now, right? But you're seeing, right? It's not, right? It's all just simple ideas. Okay, so we're saying that incomes, y, are explained by some exogenous factors of households, C0, right? So household spend, plus household spending a share of disposable income, after-tax income. Then also businesses are investing for reasons that are exogenous that we don't understand, I0, plus businesses are investing more based upon their forecasts about future macroeconomic performance, I1 times Y. But then they're also being impacted by the cost of doing business, the rate of interest, Higher rates of interest negatively impact the cost of doing business, and so we subtract off I2 times I. And then also governments out there spending money too, contributing to household incomes and contributing to business revenues. And so we add on, so far, G, government spending. Okay, and that's our model so far, right? And that's we're really getting it's a pretty good little model, right? Explaining how the macroeconomy works just from super simple ideas. You're already getting a very clear and logical way to explain a lot of things in the macroeconomy. In other words, if somebody started asking you, peppering you with questions about the economy, right? And, oh, well, the Fed's going to raise interest rates and that's going to do blah, blah, blah. And you could be like, well, maybe, maybe not. Here's how it's likely to do it. Just boom, 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 boom. And look where your interest rates are affecting various decisions of households and businesses. Explain your reasoning. People start fighting with you. You can even write it out mathematically. And boy, nothing kills an argument quicker than math. So, So I mean, think about right now. Here I am speaking to you in the winter of the very end of 2020. It's been a bit of a difficult year, and a lot about the future remains unknown. Maybe a little less than a month ago, but boy, still a lot remains unknown. And so, of course, business investment is slow. I mean, put yourself in the shoes of a business owner. Is now the time right for a big expansion? Maybe I should just put my money into government bonds, right? They're turning a sure 3% or whatever. Where should I be putting my financial capital? It's a really tricky decision, right? And so a lot of economic activity right now is sort of stuck, right? And it's stuck because nobody's quite sure what that value is. Everybody's trying to forecast it. In the very final section of this, we'll turn quickly to business regulation. Now, your textbook talks much more at length about business regulation than this video is going to do. There's just a couple things I want to say about it here, right? The first thing is that we should understand that business has always been regulated in the public interest and always will be. Things. What we argue about is different levels of business regulation and how we're going to go about regulating business, and with good reason, right? Because when we're limiting what business can do, of course, we're limiting how that investment process can occur, and so that's an important decision. But at the very basics of things, of course, how much is a kilogram? How much is a pound? These are matters of the state, right? The state determines these things. And has since the time of Caesar, as the coin here, right? Thousands of years. What's a mile, right, of distance? What's a kilometer? These are bases of state, right? That we decide as a society what these things are, right? We don't let. You imagine go to the store and be like, I want a pound of roast beef or whatever, right? And for the rest of the world, a pound is a weird old-fashioned weight measure. I want a kilo of roast beef or whatever, The grocer gives you a small bag of roast beef, and you say, this isn't a kilogram, and the grocer says, oh, that's my kilogram, right? No, that's what I call a kilogram, right? It's called my grocer's special kilogram. It doesn't work that way, right? We have to have sort of common understanding about performance for markets to work effectively. And so there's always a base level of regulation of business in every society. And so the reason why we have to decide those things as a society is because, as we talked about a few chapters ago, wherever there's markets, we have suppliers and demanders, individuals meeting in this marketplace that don't really know each other. They don't really know what to expect of each other, and they don't really know what each other's objectives are. And so we need to create as a society some expectations of performance about how those exchanges will take place. Now, those may be very simple things like weights and measures. They may be more complicated things like requiring that certain types of things are not ingredients in foodstuffs. So, for example, that there can't be toxins in foodstuffs or something like that. It may be regulations about how businesses will use public resources, so how businesses will use the water supply, what they will emit into the public resource known as air. But in all cases, what these regulations are society making decisions about what is appropriate in the marketplace, or in some cases, right, what's completely inappropriate for some to take place in the marketplace, such as illegal drugs, prostitution, things like these, is just not acceptable to occur in the market, and so we completely forbid those. The social expectation of market performance in those cases is that the market simply will not exist. Just another illustration of the millions of ways in which we as a society are constantly making and remaking this thing we call economy, and in which it's a social discussion. All right, that's plenty enough. This has gone on far too long. We'll leave it there, and we'll see you next time. Take care, everybody. Have a good day.